The topic is international transmission of monetary shocks. I think everybody will agree the argument that when there is a monetary policy shock in the core country, in all analysis, there's U.S. monetary policy changes, and other countries will feel it, and especially for the emerging market, there is a lot of huge response. Like when there is a tapering talk in May 2013, and we see that for India and Indonesia, the equity market index dropped dramatically. Then we would like to base our analysis on this famous Trilemma Framework, which is one country cannot achieve stable exchange rate, free capital flow, and independent monetary policy simultaneously. And in practice, this Trilemma framework has been interpreted into different views. One is that flexible exchange rate regime produce monetary policy autonomy, and seems that capital controls are ineffective. There's a lot of discussion supporting this view. And also, there are several alternative views finding out that the flexible exchange rate might not be that effective in granting countries to have independent monetary policy, because when countries would not like to depreciate that much because they are afraid of it's going to hurt their affordability of the foreign debt payment, or they won't like to appreciate that much because it's going to hurt the export. And also we find there's some literature find that when there is global financial crisis, there's the nominal flexible exchange rate does not help that much. Helen Ray's paper is on this. She argued that this actually is a dilemma, not a trilemma, because the capital flow will highly correlated regardless of nominal exchange rate regime. Then based on the different views, there are competing recommendations that one is to support this prioritized exchange rate flexibility, for example, IMF's Article 4 reports, and also is because there's capital control leaky or is too costly. Another group is to support capital control to confer real monetary autonomy, like what we have discussed in the previous literature based on those findings. So in our paper, we are going to investigate does a flexible exchange rate regime really confer monetary policy autonomy, and which one, either the capital control or flexible exchange rate, is more effective in pursuing this goal? Our model is that the monetary policy of country K is a periphery country's monetary policy. Is going to be affected by three parts. The first part is linked to domestic need, which we formulated based on the Taylor rule, which has been driven by the domestic growth and inflation. And the second part is the passive response to the U.S. monetary policy. Here we use U.S. policy rate changes to formulate this U.S. monetary policy shock. And for this part, we are going to introduce the combination, the regime combination of fixed and flexible exchange rate, and with capital control and without capital control. So altogether, we have four regimes, and interacting that regime with the U.S. policy rate changes to see whether we are going to find heterogeneity or different coefficient estimates for different regime combinations. The third part, reflecting global risk appetite, which we are going to indicate it by the VIX. Based on that framework, here is a model specification. Here is this policy, periphery countries policy rate changes. And we also introduced this one period lagged policy rate level to incorporate the room for the periphery country to change their policy rate. Since we expect to see a negative estimate for lambda, because when it's closer to the zero bound, it's at zero level, and there's not going to be too much room for the country to decrease further. So that's the purpose we introduced this one period lagged interest rate level, and this one corresponding to the part one, which is a desired change based on purely domestic factor, and here is a core. It's a core of our model. It's how the peripheral countries' interest rate changes respond to interest rate changes of US, and we use a VIX to indicate the financial cycle. Let's see. Here is for the desired domestic policy changes. Here is the formula, which is based on the Taylor rule. And for the gamma 2, is our tool to investigate the issue, which is D is a dummy, and D fixed NC means there's a fixed exchange rate and no capital control is going to be equal to 1 and otherwise 0. So altogether we have 4 coefficients. In this way we don't have the benchmark, so we can tell directly from the beta estimates to see what's the coefficient and whether it's significant or not significant. If it's significant estimate, that means the peripheral countries' interest rate is going to be affected by the US policy rate changes significantly. Here is just a layout to, since the previous one has a limitation. One is since June of 2009, U.S. interest rate reached the lower bound. There's no room for it to decrease further. So it's a QE episode. And then based on this method, it's not possible for us to incorporate that part appropriately. So we develop our model in a way to accommodate the QE period. After the US interest reach the lower bound, what can we do is that the model specification 1 is very similar to the baseline 1, except here the US rate changes is a latent one. The latent one will be the real observed interest rate changes if it's not reached the lower bound. But when it's reached lower bound, what people will expect to see is that they will base on the information of the money supply, which is MT, and the output, aggregate output level to gauge what the interest rate of US should be. So based on this framework, then we introduce this likelihood function to incorporate. The first part is to take care of the episode before the QE episode, which we have observed in U.S. interest rate changes. And for the second part, which is take care of the QE period after the U.S. interest rate reach the lower bound, we are going to use the equation 3 to approximate the interest rate changes of U.S. So based on this one, we can estimate what happened to the coefficient. Okay, for the data, There are several new things in our data. First is for the Taylor rule part, we use IMF's wheel data revision of the prediction for the inflation and output to get the Taylor rule part. So it gave us a better measure of the shock in inflation and output. And for the policy rate, interest rate, we use monetary policy rate and discount rate. When the monetary policy rate is not available, there's a short-term policy rate. We also introduce this long-term bond yield to check what happened to the long-term rate, and we find very similar result with the short-term one. For the capital control index, we use Chen-Ito financial openness index, but with 1 minus it changed to, if it's equal to 1, that means very strict capital control, and if it's equal to 0, that means it's total open. And for the nominal exchange rate regime, we use for the benchmark model, we use Reinhardt and Rogoff exchange rate regime classification. And for the category 1, we define it as a fixed exchange rate. The remaining 3 categories go to the flexible exchange rate. For the Eurozone, here we do not introduce the individual countries in the model. We only choose Germany as a representative country in the estimation. So we are going to expect to see if the capital control work is more effective, then we expect to see that beta 1 and beta 4 are significant. If a flexible exchange rate regime are the key to have independent monetary policy, we are not going to see a significant beta 4. So for beta 4 and beta 3 should be insignificant. So that's how we test this competing view for this discussion. Here is some country example. The left column is countries without capital control, and the right column is countries with capital control. There's Hong Kong, China, and there's Ecuador. And for the row, the first line is fixed exchange rate. The second line is flexible exchange rate. So it seems there's Peru and there's Philippines. From this visual test, it seems there's a higher association for the countries without capital control and the lower correlation or association for the countries with capital control. There's some implication, so we're going to check it statistically. This one also is we do this is unconditional plotting. The horizontal axis is interest rate changes of a U.S. This is the horizontal axis, and the vertical is the interest rate changes of peripheral countries. The reason why we have fewer dots here is that we do some grouping. For each, we divided the country along the horizontal axis into 20 groups and get the group average to emphasize the trend. So we see that here is a very consistent story with a previous figure. It seems is the fitted line. There's a positive correlation between the U.S. rate changes and the peripheral countries' interest rate changes for countries without capital control. Okay, so then what's the main finding based on our baseline model is that we find that a country with a fixed exchange rate and without capital control, increase in U.S. rate by 100 basic points is followed by increase in the interest rate by 65 basic points on average. And another group which is going to be affected significantly is a group with a flexible exchange rate and no capital control. The effect is going to be lower than the first group, which is 45 basis points, but it's still significant. For countries with capital control, we do not find a significant effect on average. That's so it seems the capital control is more effective. Here are the results as pointed by our discussant is based on the OLS regression, and we try for the short term is short term. The short term means short term policy rate, and we have the period from 1990 to 2009, and then we divide it into the 1990 to 1998 and 1999 to 2009. The reason we use 1999 is because of the Eurozone introduction, and also is kind of a median point. And we find that the model works much better for the second period. For the second period, and also we try the second period with long term. Here is long term government bond yield. We find what we see is that here here is what we want to examine. Let's say this one is a dummy with a fixed exchange rate and no capital control, multiply the US interest rate changes. And this group is a flexible exchange rate without capital control. We see that for those two groups, the coefficient estimates are significant. And for the other two, with capital control, there are no significant estimates. We also try some robustness check. We redefining the capital control, change it into the continued type of measure, and also we check redefine the exchange rate regime according to the AER, EAER category, and also we use this for the Taylor rule. The very last column is the Taylor rule. We instead of estimate the coefficient, we just assign it as the classic way. It's 1.5 multiply the changes in inflation and 0.5 multiply the GDP growth. So we do it for both short term and long term and find that very strong evidence. We do it for also use the SUR. It's a seemingly unrelated regression, and for both short-term policy rate and long-term government bond yield. But here we have some additional findings, is that seems in this SUR regression result, the group of fixed exchange rate with capital control is going to be affected very differently between short-term and long-term, and both significant. So based on this finding, it might be safe to argue that actually which is policy tool gave us strong independence of monetary policy is a flexible exchange rate plus a capital control. This one, what I presented here is the one corresponding to the lower bound episode, which is use the likelihood function. Here, since there's optimization involved, we try use the OLS estimate as the initial values, and also use that based on that initial value, we multiply and minus one standard error. Actually, we have three. Altogether 6 scenarios to test. I only select this one to present, but actually we have very similar results across all the trials. So we still have a very supporting finding here for the fixed exchange rate and without capital control, and flexible exchange rate without capital control. So it's very consistent with the baseline result. Okay, then based on all those results, the conclusions are, for the pre-QE episode, a flexible exchange rate does not reliably deliver monetary policy independence, but capital controls do. In open economies, a flexible exchange rate regime can help in keeping short-term policy rate less affected by US monetary policy changes compared to those on a fixed exchange rate. However, for the QE episode, the responses of peripheral countries' policy rate to money supply approximated monetary policy of the US are much lower. Yeah, that's all for my presentation. Thank you.
I'm going to discuss 3 issues that I found with the paper and over the course of the next few minutes. And but before I begin diving into the paper, I want to put the results of the paper in context of the recent literature. So I want to start by describing the paper by Opsfeld, which studies empirical evidence to study the relationship between monetary policy independence and exchange rate regimes. So the specification that they use is the change in interest rates of the domestic country regressed against the interest rates of the base country, and they also add an interactive variable for the nominal exchange rate regimes that is followed by the domestic country. They add delta wicks to capture unobserved global shocks, which might move the interest rates of the base country and the domestic country simultaneously. They do this study for open economies, whereas in your paper you have included the entire data set of countries. Their findings are that open economies with flexible exchange rate have considerable monetary policy autonomy in the short end of the term structure, but in the long end of the term structure they find considerable co-movements with the interest rates of the base country, where they first, in their baseline regression, they use the US as the base country, and then they map the base country for each domestic country separately. So you might have a country pegging to Germany, so they account for that, and their results are robust in that. So your paper builds on their specification by including not restricting themselves to only the open economies, but the set of all economies, and the way you have control for the capital control regime for the countries is by introducing the interactive dummy variable for each combination of the exchange rate regime and the capital control regime. So you have summarized your findings. So just to go over it, the authors say that capital controls give country ability to pursue independent monetary policy, and they don't find significant evidence that flexible exchange rate regime confers monetary policy autonomy. So the authors have used OLS regressions for their in their baseline estimates. So I'm gonna go over 3 issues. You have used pooled OLS in the baseline regression. Now, what pooled OLS does is that it ignores the panel structure of the data set and it lumps together the data set as a big cross section. So given strict exogeneity conditions, you might have consistent estimators, but they're not efficient. And this is because observations might be correlated within a country I. The standard treatment would be to pool, to basically cluster the errors, the standard errors by country, and then report robust standard errors. So this is more of a clarification where I'm asking if the errors reported are robust. The second issue that I'd like to go over is basically the introduction of country fixed effects. So, I mean, in order to address concerns about omitted variable bias of unobservable, it might be good to include, to basically check the robustness of the results by adding country fixed effects in the regression. The third issue is about the endogeneity of the lag policy rate, which is included on the RHS. If we go over the baseline specification, you have the first lag of the interest rate on your RHS, and on the LHS you have the change in interest rate. Now, if you rearrange the terms, it can be written, you can have the lag dependent variable on the right hand side, and then it basically transformed to a classic dynamic panel specification. It can be shown that due to the lag dependent variable on the RHS, the estimated coefficients might suffer from the nickel bias, and using GMM methods as those proposed by Orlano Bond might be useful. The fourth is more of a suggestion as to the effectiveness of Chin-Ito index to capture the capital account openness of the country. It basically, the Chin-Ito index records a change in the capital account openness only when there's an overhaul of the restrictions. Maybe the capital account openness of Asian countries in the 2000s may not be captured by the Chin-Ito index. So one way would be to use a de facto index like the Lane-Milesi-Ferretti index, which might give you robust, which might basically make the results robust. So these are my suggestions for the paper.